Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We have some economic data coming out right now. ISM Services data coming out, 49.9. The headline consensus on this was 52, so now kind of flirting with a little bit of a contraction there in the services part of the economy, which, again, is about 70% of the U.S. economy. Let's get right to it. Steve Miller, chair of the ISM Services PMI, on that data. Steve, I'm looking at that headline data, 49.9. That's below 50. Talk to us about that.
Good morning. Thanks for having me back. The it's 0.1% below the flat in services industries. Flat is bad. We've seen long-term growth, and when we get to flat or just below flat, certainly negative indicators. On the positive side, we track the numbers by industry and how they contribute to overall GDP. What we're seeing is a slight increase in the percent of GDP that's representing growth, and a slight decrease in those that are saying that they're in contraction territory. What we saw bringing the number overall down was for accommodations and food services, and the real estate rental and leasing, although both still in expansion territory, they're not as high or as fast a level of expansion as they were last month.
So I was confused as to how ISM Services employment actually ticked above that 50 level, whereas, say, new orders just tanked to 46 and the overall index is below 50. What does that mean?
Well, on the employment side, my interpretation of those numbers is that we're still seeing confidence that the tariff situation is going to get worked out and we're going to be able to return to growth. But the new orders and actually seeing backlog as well, backlog of orders, we're seeing those very low. And another data point is when I look at the average of new orders and backlog, this is the lowest that it's been since two other points in the last 20 years. One was the beginning of the pandemic in March and April, and the other was in the 2008-2009 timeframe in the Great Recession. Wow. So for me, that's the biggest red flag, is the drop in new orders, as well as both the average level between the new orders and the backlog of orders.
So we got new orders lower. That's concern about just the economy slowing down. And we've got services prices paid coming in much higher than expected. Is that inflation?
So can't say yet whether it's inflationary, but I would tell you that the 2-month growth rate is what we saw just at the start of the acceleration in inflation back during the pandemic. So definitely, that's all right, also
Steve,
a
we
big
appreciate it. Yeah, we know you got to run, so we'll let you go. Steve Miller, chair of the ISM Services, joining us there. Really rough new order, so we will keep track of all of that as it goes.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So the economic data we keep hearing is going to be a few months off till we see any negativity hit the hard data. But let's just go over some of the data we got today. We got the ADP employment number disappointing, coming in at just 37,000 jobs. Then you had the ISM Services number, and it was pretty rough. You had the overall index below 50. That's contraction territory. But the big thing was new orders coming in at the lowest level like we saw back in April 2020. No one likes April of 2020. Also back in 2008, 2009. No one liked 2008 and 2009. Joining us now for more, Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike, is this a stagflation kind of thing?
Well, if you took it at face value, it is, in the sense that we're looking at prices going up and activity going down. What we haven't seen is, as you note, the hard data completely reflecting this. We're starting to get numbers that do. Remember, we saw a big drop in imports during the last month, and that was largely because so much was pulled forward because of the impending tariffs. And so that will have an impact on second quarter growth. But we're not at this point able to say exactly where we go from there. It looks like services are bad, and I know you had the director of the ISM Services on earlier, and he said that the new orders really are looking bad right now, and that's kind of a scary thought.
Hey, Mike, in our group chat here, I dropped in a note earlier that I said, maybe in a few months' time, we're going to look back on today as the beginning of something, whether it's stagflation or whether it's a recession, whether it's inflation really rearing its head. Am I being overdramatic there?
I don't know if I would say today, but it could be this week. Let's see what happens on Friday with the jobs report. This may be sort of the last hurrah week where we see numbers that are okay in terms of those things. The big question is going to be whether ADP reflects reality or not, because any number like that for Friday's payrolls figures would really scare the pants off Wall Street and get everybody excited about Fed rate cuts, even if they're not going to happen right away. So, yes, this could be
not mincing those
a time
words
to remember.
Nice.
Nevertheless, then how do we think about ADP versus the jolts that we got yesterday? I was thinking, is it the companies just aren't hiring, but they're not necessarily laying off either? How do we square those two together in the broader economic jobs picture?
Well, it's not easy to square the two, except that you note that ADP, that the JOLTS rather, is 2 months old. So it is past data, and things could certainly have changed, which ADP suggests might be the case. Now, with ADP, what we're not seeing is whether companies were letting anybody go and whether they have openings that they want to fill. It just tells you they didn't hire very many people or add to payrolls. Now, it has historically been that ADP is usually way off from what the private sector hiring is in the non-farm payrolls figure. So we'll have to see how that proves out on Friday. Last month, ADP said there were only 60,000 private sector jobs created, and the government found 167,000. So I don't know whether ADP or JOLTS gives us a better idea of what's going on, but I don't think people are going to pay a whole lot of attention to either one once we get the Friday figures.
Tariffs, Mike. We have so many tariffs, they're very hard to kind of keep them in focus here. There's so many out there. Do we have any idea kind of what percentage of the tariffs have found their way into the economy at this stage, or is it just too early to tell here?
Well, there have been some rough back-of-the-envelope calculations that about what Bloomberg Economics has done one. About 6% of U.S. imports have been affected by tariffs, because we're looking at autos and we're looking at steel and aluminum, basically. More tariffs likely coming. The Congressional Budget Office just a short time ago put out a couple of new reports, one suggesting that the big beautiful bill is going to add something like $10 trillion on to the overall deficits over a period of years, and then that the tariffs would reduce that by about $3 trillion. So if all the tariffs were carried through, and that's the caveat that the CBO puts on their numbers today, that they don't know what tariffs are actually going to be imposed. So that's the hard part for everybody at the moment, is how much are we going to tariff people, and who are we going to tariff?
Mike, what's that nerdy chart that you have on your desktop right now?
Actually, I was looking at steel today, and because of you, of course, Alix Steel. And the fact that when Trump put on his tariffs in 2017, we saw a short-term rise in employment at steel mills, but then that rolled over, and the number of jobs in the downstream, people who use steel in their industries, fabricated metal producers, really fell significantly, lost about 75,000 jobs there. So it'll be something we're going to have to watch those two numbers in Friday and the following month's reports on how the steel tariffs are affecting the economy.
Yeah, I love that.
So I think I better come in on Friday. It's something to be a big day.
Oh, are you going to be off Friday?
No, I think I'll be in. It's jobs day.
The thing is from what we've been learning, maybe we'll get little cracks, but it's really going to be in the next 2 months maybe that we'll get hard data. So I feel like you could still get that on the Jersey Shore, but
it's going to be rainy.
TBD. Well, then definitely come in for that. Yeah. All right. Thanks, Mike. Really appreciate it. Michael McKee, Bloomberg National Economics and Policy Correspondent.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's pick up with one of the stocks that Nora was just talking about, and that is Wells Fargo. Taking a look at that asset cap finally being removed. And what does it then mean after the 7-year-old cap is removed for CEO Charlie Scharf? Joining us now is Hannah Levitt, Senior Finance Reporter from Bloomberg News. Now, Hannah, Wells Fargo has been working at this for a very, very long time. How are they then positioned for this next stage of growth?
Yeah, so this has truly been such a long saga for them. Like, I started covering Wells Fargo more than 7 years ago. They had just gotten put under this cap at the time. I was still enjoying my mid-20s, and, you know, now we are no longer there. For Charlie Scharf, this means that he can finally play offense. He can, you know, they're not capped in size to their level at the end of 2017 anymore. And remember, that's been a huge deal for them along the way. I mean, some of the businesses that he's marked for growth, like the trading business most notably, that's been constrained because it's more balance sheet heavy, and they haven't been able to allocate that balance sheet because they're restricted. And like, just for context, JP Morgan, the biggest U.S. bank, has grown almost an entire Wells Fargo in terms of assets in the time that Wells has been capped.
Wow. All right, Hannah, full disclosure, I have my checking account with Wells Fargo, but I'm guessing the CEO and the management team there, they want to do something more than that. They think they can do a little bit bigger and better than Paul Sweeney's checking account. So what are some of the businesses, you mentioned trading, are there other areas where they think they can really grow by allocating more capital there?
Yeah, absolutely. So the businesses that Charlie Scharf marked for growth, in this time while he was running the firm, but it was still under the cap, were investment banking and trading and wealth management and credit card. But he was saying on CNBC today that virtually every business, aside from mortgage, which they've said they're shrinking, and remember, Wells Fargo used to be huge in mortgage at one point. They were churning out 1 in every 3 home loans in the country. Every business other than that should grow now, and they have room to do that. But I think those businesses where they've already said that they're targeting growth, that may be where the earliest moves are. We've reported that they're working on a high-end credit card, so that could be something that people see. But yeah, so it really it goes across all of those and beyond now because they don't have this constraint anymore.
So how quickly can they scale in the other parts of their business?
Yeah, well, it's an interesting question, right? Because we've seen, the tales of banks trying to grow too fast and then having, a calamitous blow up. And so that's something that they definitely want to avoid. And Charlie Scharf has talked about that it's not like an on switch day one, but it does give them more flexibility so they can, the most immediate thing is the trading business where they just have capacity today that they didn't have yesterday. But besides that, it's more being able to lean into more enthusiastically those growth initiatives that they've already kind of outlined.
Right. So, Hannah, they now have the regulatory capability to maybe do more, to maybe grow a little bit more quickly. Do they have the balance sheet to do that? Do they have the capital to do that?
Yeah, they have a ton of excess capital, and that's been a theme throughout. I mean, even in the earliest days of the asset cap, like they couldn't deploy that capital, so they gave investors a bigger dividend and more buybacks than they were expecting. It was sort of like you wouldn't think that would be the outcome, but it was at the time. So they've had excess capital, and also because the banks in general were preparing for the possibility of tougher capital rules that have not panned out. So a lot of them have been hoarding capital anyway, sitting on a bunch of extra.
What we're seeing in Wall Street is definitely a competition for talent, particularly if you wrap in hedge funds as well as huge asset managers or private equity. Can Wells Fargo play in that game?
Yeah, they already have been. I mean, they hired Fernando Rivas, who is the head of the corporate investment bank there. He was a major hire from JP Morgan, so that was huge for them. And, they've made other hires over the years. Doug Braunstein is there, another former JPM executive, and he's vice chair. They have Barry Summers running wealth, so they have, they've been able to get talent at the highest level, and then even further down as well.
All right, I think the street kind of like it. The stock's up about 0.7% today. It's up 8.5% year to date, up 30% over the trailing 12 months. So it looks like the street is kind of warming up to a story which has been kind of middle of the road given some of the regulatory constraints. We'll stay on top of that. Hannah Levitt, thanks so much for joining us, a Bloomberg Senior Finance Reporter on Wells Fargo.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to live from the Gaylord National Convention Center right here in Maryland. We're overlooking the Potomac. We are at BNY INSITE 2025 as we talk about wealth management and all the tools and tricks that can be used to help navigate these markets. We're also continuing to take a check-in here on what's happening in the overall market. We want to turn now to today's big take story. It talks about Tesla and what autonomous driving and robo-taxis, say in Austin, as Elon Musk keeps talking about them, are talking about investigating whether the system is actually too dangerous, even if you have a human behind the wheel. Joining us now is Global Auto's editor Craig Trudell. Craig, so here's the title of the big take. A fatal Tesla crash shows the limits of full self-driving. Walk us through the details of what the issues are surrounding completely autonomous vehicles.
Yeah, so I guess maybe the thing to start with is the Teslas that you can buy today that are on the road now are not that, right? They are not autonomous. You can pay extra for a system called full self-driving, and yet it's a misnomer. It's a system that you have to pay attention to at all times. If you get into a crash, it is on you, and we've seen that play out. When Tesla customers have tried to come after the company says, look, we warned you, we told you that you're responsible for driving while using this system. The company is trying to make this leap. It's been trying to make this leap for years to eventually get to a point where you do not have to supervise, and even to take it further than that, take the human out from behind the wheel altogether. And we hear Musk, talk about that quite a bit lately because it's something that they're actually trying to commercialize, even just in the next matter of, next week or so. There's a lot of questions about how exactly they intend to do that, whether they can do it, especially after he's predicted, year after year that they're on the cusp of doing it. And part of the reason there are doubts is because of the hardware, and I think that's kind of an important aspect of today's story is this particular crash involves, an incident where a driver was using full self-driving, driving into the sun, and that appeared to play a part in the crash, which resulted in a fatality, and it led to a federal investigation that is ongoing.
I mean, this is all very much feels as part of the growing pains as we kind of understand this technology and how it works itself out. So what are the steps that Tesla is taking and that the regulators are taking at this time?
Yeah, so we should acknowledge that this incident happened in November 2023. Tesla has changed. They've made upgrades both to hardware and software. Hardware for certain customers, I should say. But in terms of their approach to the sensor system for their vehicles, Elon Musk has been really sort of out on a limb and having this view that all you need is cameras. And companies that are also in this space, I think the one people recognize the most is Waymo, the Google company, and they use a mix of camera, radar, and LiDAR, and their sensor set is much more expensive. It's more extensive. These sensors are placed all over the vehicle. But the sort of bet here on the part of Waymo is that is worth it. It will mean this system is safer. What Musk has tried to do is go with the cheaper route, go with the system that he can afford to put in every Tesla, and make this bet that he can develop his way to autonomy faster by sort of leveraging the broader Tesla fleet, even if it means putting cars on the road that draw scrutiny from federal regulators as to whether or not this is unreasonably unsafe.
So, Craig, I think Elon Musk is back at the company. What does that mean? I mean, are you hearing anything like, okay, now we can get back on track, now we can really move forward, maybe at a higher velocity? What's that mean?
Yeah, I think it's difficult to tell at this point, because he's kind of coming back to business means coming back to so many businesses, right? And so on a day-to-day, we're seeing him travel to his various companies, devoting some time and attention to them. But it's not as though he's sort of 100%, focusing in on Tesla and neglecting all of his other businesses. We see him, regularly engaging with, users on X about, troubleshooting problems that they have with that service. I would say he is, more actively engaging there on Tesla matters, and definitely is trying to sort of send this signal that, okay, it's time to get back to business here. But whether or not that's, resulting in sort of tangible changes at the company, I think remains to be seen.
Quickly, 20 seconds. What's the rush for autonomous driving?
I think 40,000 people die on U.S. roads every year, right? And so the rush, of course, is to bend that, to change that. And I think one of the challenges that you have if you're a company in this space is we've now, seen a lot of companies pursue this for, roughly a decade. That number has not budged. So, we still have a long way to go to where this capability is, putting a dent in those figures.
All right, Craig, thanks a lot. Really appreciate Craig Trudell joining us, Global Autos Editor on Tesla and autonomous driving.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.